Okay, good evening, everybody. Impax Asset Management has been on AIM since 2001. If you want to make some quick notes, our ticker is IPX. The principal nomad and broker is Peel Hunt. We also have equity developments as research writers who we pay for research. Our market cap today is about £270 million. I own about 7.5% of the company, and I've never really sold any shares, a little bit of share sell on the margin, but never really sold anything. And my team, together with me, own 1/3 of the business. So what I'd like to describe in the next few minutes is an investment management model, because we're investment managers, in which management is very much aligned with external shareholders, such as several of you in the room, and a number of well-positioned UK small cap companies, and one of the biggest sales organisations in the world in the investment management space, to grow a business which is serving institutional investors all around the world. What you'll find when you go out for drinks later is a pack of information from Impax. It includes our interim results, which were published just a couple of weeks ago. And I've been a bit lazy tonight, I'm afraid. I've just brought the interim results slide deck here, and therefore I'm going to pick a few slides to illustrate some key points. But if you'd like to go into the detail, then there is a big hard copy pack waiting for you when you go for drinks. And there's also a lot more information on our website. So what is it about investment management that's exciting, compelling, and a real opportunity for investors to make extraordinary returns? Well, for those of you that have invested in this sector, you'll know that if you get the model right, if you're an investment manager who's got very good investment performance, a differentiated offering, a great route to market, and a stable team that's bought into the long-term participation to stick with the company, then the returns to investors are extraordinary because of the very low cost base relative to the revenue potential, the scalability of the model. And because we've been in business for 20 years, and actually I started this company on July the 1st, 1998, so it's literally our 20th anniversary within 10 days' time. If you stick to your knitting, so to speak, and deliver a consistent service to institutional investors, and that means strong performance, great client service, etc., and what you do is very different to what they can find elsewhere, then you really are well placed for continuation of growth. And what we've achieved at Impax, as you'll see in a moment, is a very significant amount of scaling to a point where we've now got just shy of $16 billion under management, £11.8 billion. But if you look at many of the boutiques that are similar to us, not in our space, but differentiated, institutionally focused, global in outreach, then they are at a significant multiple of scale to us. Ashmore is an example I like to talk about. It's different to us, but similar in the context of the business model. So what is it that makes Impax different? Well, as you probably know, there's a lot of pressure at the moment in the investment management world to go passive, to put your money into ETFs, to get fees down, and to just ride the grinding up of the market, which some would have you believe is just going to go on forever and ever and ever, pay low fees and make lots of money. There's nothing necessarily wrong with that thesis. It is a perfectly sensible thing to do, to put a good chunk of your pension portfolio or your ISAs, your savings, into passive funds. But actually, there's another way of making money, a way of making more money probably than through passive vehicles, a bit more risky, and that is to back boutique investment managers and their differentiated ideas. So there are many who study investment management markets who would suggest that there's a splitting, a bifurcation going on at the moment. A lot of money moving to passive, but also a lot of money seeking these boutique specialist investment managers that do something different. Where you don't want to be in investment management is in the middle, where you have generic products actively managed, high fees, high cost base, but you're not really doing something different to the mainstream, or really that much different for many than going passive. So, of course, what I'm leading to is the fact that Impax is deliberately positioned as a specialist boutique. What is our specialty? Well, it's sort of written there on the front cover of our interim slide deck, which is this idea that we focused with a very differentiated investment idea, which is that the transition to a more sustainable economy is going to lead to extraordinary returns in some industries and risk in others. What do I mean by the transition to a more sustainable economy? Well, in very simple terms, as the planet grows from, roughly speaking, 7.5 billion people today to at least 9.5 around the middle of the century, maybe even 11.5 by the end of the century, more and more people moving to cities, higher standards of living being sought by everybody. There's more and more pressure being put on natural resources. Environmental quality is under threat in many areas. There are new diseases arising out of lifestyle type problems, diabetes, cancer, etc. There's education deficit. There's huge opportunities around creating financial products in middle income parts of emerging markets. And so if you stack up all these opportunities, the underlying themes essentially are can be drawn together by this idea that we need to use our planetary resources better. We need to be careful that we don't pollute the places we're living in. And there's plenty of evidence to suggest that a combination of consumer demand, innovative technology, and regulatory shaping of markets for private sector capital will lead to some great investment opportunities. So I can imagine that if I had a sort of heat map in this room of what people are thinking, half of you would be thinking, hang on a minute, that sounds a bit like ethical investing. Is this an ethical investment group? Well, the simple answer is no, that's not what we're doing. We're investing in a very mainstream capitalist way to try and find those ideally placed companies with smart management teams, great business models in high growth markets that just happen to be connected by this idea of resource scarcity, urbanization, population dynamics, etc. Having said that, although what we do appeals to capitalists, it also appeals to those who would like to see the world slightly different to what it is now, who would like to reflect in their investment beliefs, if they're, say, church-based investors, in their investment portfolios, who, if they're millennials, would like to see the world somewhat different to what it is today. And therefore, when I describe our portfolios in a moment, I hope you'll get the sense that what we're doing does also appeal to those who might be categorized as ethically or morally motivated. So in that sense, we've got an offering which appeals to two very significantly different, but large, and in the case of the ethical investment group, potentially rapidly growing subsectors. So that's what I mean by the transition to a more sustainable economy. So this is our business today. We're managing at the end of March £11 billion. That was 11.8 billion by the end of May. You can see there's two colours there. That's reflective of the fact that in January we bought a business in the US doing something very similar to us, but with US-oriented investment ideas, US equities, US fixed income. Crucially, that business was a company that we've known for 10 years because we've been partnering with them to, in 2008, launch and then subsequently build to a significant scale a mutual fund to wrap Impax's great ideas in the environmental space. And so based on 10 years of partnership, when that company, which was called Pax World Management LLC, when that company's shareholder became uncomfortable as a long-term owner because of intergenerational problems and nothing to do with the company itself, then we were really well placed to buy it for a sensible price and integrate it, rename it, and make the Impax business not only a little bit bigger, but crucially equally exposed to the US market as it is to the European market in terms of client base. So our 11.8 by the end of May billion pounds is almost equally split between US clients and European clients. It's almost equally managed by US staff members as it is European and Asian based staff members, and therefore we can hold ourselves out to investors in both the key asset gathering parts of the world, if you like, Europe and North America, as local. And that's crucial when it comes to building confidence and generating further scale. So this chart is sort of the history of my life for the last 20 years. So back in 1998, I'd recently left McKinsey. I was fascinated by the idea that technology and business models with environmental solutions could help improve the environment, but I was really focused on companies making money and finding ways to back them. So contract with the World Bank, $25 million, £15 million in 1998, and you can see how we've grown through a couple of very significant financial crises, of course 2000, 2001, 2008, without really going backwards. We've had a couple of bumps in the road as sort of companies we've invested in the, say, industrials area or Asia have experienced headwinds. So 2011, 2014, we were slightly behind the market, but broadly speaking, over most 3-5 year periods in that 20-year history, we have outperformed the global index. And that, of course, is a great story to tell if you're trying to appeal to capitalists who want to make sure they're backing investment managers who are going to go ahead and beat the market. So the orange bit there is the acquisition that we made, and that's taken us from 8.2 billion pounds at the end of March up to the 11.0 or 11.8 from March and then into May. So all these slides are available later if you want to go and have a more detailed look, but essentially let me give you a couple of examples of how we think. So right now in the power sector, then of course you can't read the Financial Times or another global newspaper without some mention of the energy revolutions underway, be it shale gas, which is bringing down the marginal price of electricity generation from gas and from coal, most of the northern hemisphere, be it the fact that renewable energy is now pretty much cheaper on the margin than fossil fuels, and that's brought down wholesale power prices, but also created the potential for instability. Nuclear power, of course, is some phenomenally bullish nuclear power markets like China. There's some countries like Germany that are pulling out of nuclear power completely, and then there's countries like the UK that can't quite make our mind up. So in that context, it's intriguing to try and think about where do you place your money. And you'd imagine that if you're in my position, you might think, well, let's put all our bets on renewables because isn't that the future? But actually, there's some problems with renewables. First of all, the technology is showing very little sign of innovation. And we're in a very strong period of commoditization at the moment where the cost prices, if you like, of solar panels and wind turbines are coming down due to massive global competition. Of course, that's eroding margins for producers all around the world. So it really has been a pretty much bad idea to buy into solar panel manufacturers or wind turbine manufacturers. It's been a much smarter idea the last few years to buy into the utilities or the independent power producers who are able to benefit from that commoditization, if you like, and much lower costs of equipment, but still sell into markets where electricity prices have been quite healthy. Where we are today is actually somewhat different. Because there's so much renewables on the system in many countries, then the challenge is for the grids of the world, the regulated balances of supply and demand is how do you balance all this renewables? Because the wind blows and the sun shines, but not really in any kind of synchrony with what the load is, what's happening to lights or mobile phones. Of course, which are not connected to the grid. So where the opportunity is right now, in our view, is to think about business models that will smooth out renewable energy and, let's face it, gas and coal in an integrated way, at a low-cost way. So there's opportunities around storage, for example, large banks of lead-acid batteries that are being rolled out in places like Germany. What's called demand-side management, which is companies that are contracting with commercial, largely customers to turn down their load when there's too much demand on the system, and companies that are building interconnectors that are linking power grids from one market to another. So if we think about the big picture of rising electricity demand, falling technology costs, then you need to go the extra step to think about new business models to back that are kind of joining the pieces in an economically efficient way. The second example I'll talk about in a relatively short amount of time is transportation. Now, you might think that I'm going to be a huge bull of electric vehicles and try and convince you that over the next 10 years there's going to be an explosion, metaphorically, of demand for electric vehicles, and half of you are going to be driving around in those things by, say, 2025. I personally am pretty cautious about that. Battery technology is still not quite at the right price points. I think Tesla has demonstrated with its Model 3 that they can't build a vehicle for $35,000. It's going to be $75,000, $74,000, a bit better Model 3 Plus, but they can't get there. The most important thing, however, is that there's no infrastructure. That when you drive your electric vehicle back to your street, and I live in London, there's a bit of a scrum for the 3 electric vehicle charging stations that are now on the edge of the street. I don't have a connection at home, which has been plumbed in. And certainly if I were to drive to work, and I don't because I work in central London, but if I were to drive to work, almost no parking arrangements at work have got electric vehicle charging. So we've got this sort of chicken and egg problem. There aren't enough electric vehicles to justify the investment, and because there's no investment, electric vehicle demand isn't picking up. So what do you do as an investor in that space? Well, without getting into the detail in the time available, what we've decided to do is focus in 2 areas. One is in emissions testing, because let's face it, as everyone wants to avoid air quality problems in cities and avoid Volkswagen-type scandals, then the demand for equipment that enables anyone in the industry to test tailpipe emissions is going to be a nice steady grind upwards of revenue demand, and with the right companies, the right intellectual property, you can make some really great returns in that area. And the second thing that we're investing in this space is consultancy, because as we all know, consultants make money no matter what's happening somehow. And so there's some really interesting consultants that are plugged into the original equipment manufacturers, the tier one suppliers, the regulators, technology companies, and they're helping to interpret and shape the revolution that's going on in transportation, not just EVs, but of course hybrid vehicles, what's going on in biofuels, and also in shipping pollution reduction as well. So that's just two quick examples. I'm just going to give you, in the last 5 minutes of my, I think it's 20 minutes of presentation, I'll leave some time for questions, a little bit more information about how do we make money. So this is our footprint. So we have 130 staff now, of whom 52 are investment professionals. Roughly half of them are based in London. 2 are based in Hong Kong, and the rest are based on the East Coast of the US. So that's the engine room, if you like, the people who manage the money. The rest of the staff are either back office, who fulfill all the trades and do all the admin, or they're client-facing. And our client-facing people are spread out across the full Impax footprint from Portland, Oregon, in the northwest of the US, all the way through to Hong Kong. So we reach our clients either through the client service people that we employ, who are targeted principally in the UK and the US to go out and search for new business, or we use partners. So we've had a very successful relationship with a Dutch bank called ASN Bank since 2001. They sell our product as an ASN fund. We do the sub-management. BNP Paribas has hired us since 2006, and we now run 5 funds for them, and I think 4 separate accounts for their clients, where we again do the sub-management, but they do the branding of the product. So a combination of direct sales by an Impax fund sold by an Impax person, or indirect sales where sometimes the client doesn't even know we're doing the work, which probably means they're not doing much due diligence, but generally speaking, they're buying a BNP Paribas or Parvest product, and we're doing the sub-management work. Now, of course, we get a lower fee for that second channel, but the marginal cost of servicing that business is very, very small to zero. So that's our business model, with a relatively small number of strategies and essentially, i.e. portfolios of these types of company. So for example, we have a small cap portfolio, we have a fixed income high yield portfolio, and we have a private equity portfolio as an illustration. We've chosen those strategies, those portfolios, because they've got what's called huge capacity, which means that you can manage a lot of money with the same underlying selection of companies, 50 stocks in small cap or 35 stocks in food, for example. And we've chosen those strategies because we believe that we can manage, in some cases, several $1 billion in each without needing to add any more analyst resource. So managing 100 million in food is pretty much the same job as managing 2 billion in food, provided you don't end up with such a big position in the underlying companies that you can't sort of move in or out. So that's really how we define the capacity. So plenty of scalable, high capacity products, investment management teams that are not distracted and are doing nothing more than investment management work, supported by a very good client base. Now, what that means for a revenue generation is that on average we've been generating about 52 basis points of fee. That means 0.52% management fee on our 11.8 billion pounds. That's about a run rate revenue of about 63 million pounds. Our operating margin is it's reported in the interim results. It's pre the acquisition, it's 32%. The acquisition is about 22%, so blend is going to be about 28%. So 28% operating margin. We brought in a little bit of debt to make the acquisition, but paying off that very rapidly. So as you can see, those are pretty healthy operating margins for a service type business. And if you look at our history, you'll have seen us grow operating margins from 15% up to that sort of high 20s over the last 3 years. We're very keen on looking after shareholders through payouts. So we started our dividend in 2008. On the right-hand side here, you can see the dividend history. The final dividend in green, starting with 0.35 pence per share, 2008. And we initiated the interim in 2014, which is the dark green. And as of the end of March, we've just announced a special dividend of 2.6 pence per share, which is linked to a carried interest or profit payout on one of our funds. So you can see there a nicely sloping increase in dividend. Pre the acquisition, I think we were anticipating moving to more of a payout ratio type level of dividend. We still intend to announce that at some stage in the future, but because we've taken on a little bit of debt to make the acquisition, we've held back on committing to a payout ratio. But there's no reason why we can't keep on ramping up the dividend. And I think the 2.6p of special dividend is a nice sort of additional reward for shareholders that have stuck with us during the period of our private equity fund being invested and realised. I think I'm pretty much out of time, so I'm going to pause there and perhaps we can move to questions for 10 minutes.
Questions, anybody? Gentleman at the back.
How is the unfolding trade war likely to affect your business?
Sorry, could you say that again, please?
How is the unfolding trade war likely to affect your business?
So I think as global equity investors, you need to be selecting geographic and market exposure and also stock exposure in parallel. So broadly speaking, if what the trade war is going to do is hurt exporters, but potentially support resurgence in some areas of the US economy, then our general approach is to be cautious about exporters, but look maybe to build positions for those companies that are benefiting from reshoring activity in the US. I think if the trade war plays out in sort of to the extent that we fear, then everyone's a loser, and I can't pretend that global equities are going to be a great place to hide. But I think with active management, we ought to be able to position ourselves into more defensive companies, for example, around water utilities or some waste management companies, or some of the businesses that are providing sort of repeat services, spare parts, etc., which are generally pretty defensive. So I think maybe another point to bring out, if you're not familiar with investing in investment managers, is that you do, through us, have exposure to a couple of hundred underlying companies, which, if you like, is a proxy for the economy. So that's a way of getting some risk diversification.
3 questions over here.
Hi there. I noticed that you have some smart beta strategies. Are these new funds? When did you start that? And do you expect that to be the majority of your assets over time?
Yeah, that's a good question. So the smart beta strategies that we run are entirely sourced and resourced through the acquisition we've made. So prior to the acquisition, all our investment was in either global equities, actively managed, or in private equity. The Pax World group brings smart beta and fixed income and some US actively managed equities. So we're just learning about the potential for smart beta. What they do, the smart bit, if you like, is some extra risk analysis that they do to filter out companies that are not interesting, and then they create baskets around the rest. The investment performance has been pretty encouraging over, I think in one case they've got a 15-year track record. So what we're doing at the moment is encouraging them to keep selling down their channel, which is the US retail channel, where the flows have been pretty encouraging, and carefully picking 1 or 2 of those strategies, one of the smart beta strategies and one of the fixed income strategies, and seeing whether some of our European clients are interested, but not over-promising as to how that's going to develop, to be honest.
Next question.
Hello. You mentioned that you've managed to keep a low cost base. Has that come under pressure from increased regulatory costs, MiFID II, GDPR, and more investment in IT?
So I think it's fair to say that regulation continues to grow in our space. You've picked on some of the key ones. Having said that, the scale of our business now is such that we don't need a massive amount of IT, because we've got a relatively simple product range and an institutional approach, or a marketing approach which is institutionally oriented. So we're not having to do lots of work to screen retail investors, for example. We've got a relatively small number of clients, 35 pension fund clients and about 35 other institutional clients. So the complexity around IT is pretty limited. The MiFID and GDPR costs, we think, have been pretty well contained. So we didn't go out with a big fanfare and say we're going to internalise all those costs. We have a slightly more nuanced approach to the internalisation of research costs, shall I say, without being too tangential. I think where we do need to pay attention is on staff, and what we aim to do is pay a median level of salary, and then we ring fence the bonus pot at 45% of pre-bonus profits, which is like a cast iron limit in line with many investment managers. And so that means that the staff know that through the cycle they will benefit in line with shareholders. And finally, because management owns a third of the company, then there's a great alignment at the equity level as well. So I pay more attention, if you like, to retaining staff than I'm worrying too much about those additional costs.
Next one.
Hi there. I think you've actually answered my question, but it was actually around, out of interest, what you see as the key risk currently to your business. So, for example, is it the retention of talent that you've mentioned, or is it downward pressure in fees, or perhaps just the cyclicality of the asset management industry in general?
Well, I think the high-level answer to that question is that the key risks of our sort of business are people, investment performance, which comes from having the right people working in the right way, compliance, which is making sure that we know what the rules are and we have systems in place and people to put in place the systems and monitor those systems, which mean that we don't stub our toes. And finally, client service, which kind of follows from the previous management steps. So I think the idea that we've picked an investment thesis which is really attractive over a 5 to 10 year and beyond time frame means that provided we don't stumble, then the tailwinds of our idea should keep us going through many bumps in the roads and mixing up metaphors, but you know what I mean. The thing that we ought to be careful of course, is competition, and competition is a double-edged sword. When the likes of BlackRock or Wellington or maybe Baillie Gifford come in and say they've got product in our space, then of course people pay attention. But our experience is that the net result of more people are interested because BlackRock is talking about it, more than outweighs the fact that we might lose some mandates because the client would rather buy BlackRock. And again, it's a benefit of being an institutionally oriented investment manager, is that the institutions almost never hire the first person that comes in the door. They always want a choice. And so BlackRock's knocking on the door. That quite often leads to a question for Impax, who they found through some of the channels, to whether we've got a product that's as good or better than BlackRock.
Any other questions?
Sorry, can I just make one other point that I should have made earlier, which is that if you're invested in the investment management sector, and there's some great companies out there, many of those companies have a very strong exposure to either the UK savers, so UK private wealth, and or UK investments. And those are great places to be, but our exposure is the opposite. So we've got very little exposure to UK companies and very little exposure to UK private wealth. And so if you're looking for sort of diversified exposure in the investment management sector, I think we're quite a nice complement to those others.
Two questions. On the competition point, is there any pressure on fees and losing clients? And then any ambitions to go into Asia or other parts of the world?
Yeah, so right from the start, because we came from nowhere without clients from previous work or experience, if you like, we've had to take a commercial approach to fees, if you like. So the fact we charge on average 52 basis points is the low end of the spectrum for investment managers of our sort of scale. So in simple terms, because we've got a very differentiated product, great track record, and there's not much competition, we're not really finding that there's pressure on fees for new business. Some of our institutional clients, after 5 years or maybe 10 years with us, ask us for a bit of a discount. And there's typically a bit of a tussle with some of the third parties as to whether we should share fees in a different way, but generally speaking, we've been pretty robust about that. So not really downward pressure on fees. You might see you will see that our weighted average fee margin has dropped, but that's simply a business mix issue. The question of Asia, I probably didn't stress this enough, but we have, roughly speaking, 10 to 15% of our portfolios in Asia, if they're global equity portfolios. We have a research team in Hong Kong that's been there since 2007 with the same individuals, and therefore, from an investment perspective, we're definitely keen on Asia. From a client perspective, it's proven a little bit more difficult to win business in Asia, but using third parties in Japan, Australia, and Hong Kong, we've been more successful in recent years than we'd anticipated. It's sort of been a bit of a ramp up, and I think Asians are now realising that there is money to be made in resource efficiency, and so we're cautiously optimistic that we can grow that.
I've got one final question. Obviously, you're here to talk about the group, and it's a management services company rather than the actual funds. The dividend, obviously progressive dividend you're declaring at the moment, what is the yield on your current share price?
So if you were to roll forward last year's final dividend to this year's final dividend, to make an assumption that we pay the same out, it's about 1.5% on today's share price. The share price has doubled in the last 12 months, particularly as a result of the acquisition, where we increased EBITDA by 42% with a 2% dilution. So that's been a real sort of transformer to the share price. So I think that the dividend has to catch up.
Yeah.
I can't give any promises as to how quickly that'll happen, but we recognise that our yield's relatively low on the current share price.
Depends on your profitability, obviously, doesn't it? If you've got
Exactly.
yeah. Thank you very much indeed, Ian. Thank you. Thanks.